Okay, good. So before we get started with chapter 6, were there any questions from the chapter 5 practice picture that you look at? Any of those problems that questions on? Have you all looked at that? So I'm assuming that you don't have any questions on, you must have understood all of those questions. And we can move on to chapter 6, which is the slide you see on the screen now. Okay, so let's go ahead and let's move on to chapter 6. Okay, and we're going to be looking at inventory cost flow assumptions. Okay, and these are assumptions that are available to companies to use in preparing their financial statements to see how they think their inventory costs flow from reporting cost of goods sold and from the standpoint of reporting their ending inventory. Okay, now the first thing though is we want to figure out how we should determine whether or not an entity even owns inventory, because often inventory is shipped and there's a period between the time that it is actually shipped and when it's received, and there's some variation in what the ownership would be under those circumstances. Okay, so when goods are in transit, we need to look at the shipping terms to determine if indeed the ownership has transferred from the seller to the buyer of that inventory. Okay, so when you take a look, we have two terms that we want to understand. One is free on board shipping point. The other is free on board destination. Now, if goods are shipped free on board shipping, that means the title transfers from the seller to the buyer as soon as those goods are put on the truck. So let's say you're buying something from somebody in New York, and they put the goods on the truck in New York, and December 31st comes, and the goods are still in Kansas City, the country, on December 31st. Should the buyer consider themselves the owner of those goods? And the answer is yes, because they went on the truck in New York, even though they're still maybe 1,500 miles away from California or whatever. The owner would count those as items, the buyer, I should say, would count those as things in their ending inventory, even though they haven't constructively received them yet. If there's some sort of accident and the stuff gets destroyed, the buyer is the one that suffers loss. Okay, so usually in those circumstances, it is the buyer that can arrange for this person to come and pick those goods up at the seller place of business and title transferred as soon as those goods get on the truck. And the seller can assume that those goods have been sold because no longer being in their inventory. Free on board destination says something different. Free on board destination says, well, the title will not transfer until the buyer actually receives the goods. So if at December 31st, the goods were still in Kansas City, go back to my example, the buyer would not include those in the inventory. In fact, they would still be considered property of the seller. They would still be included in the seller's inventory. Free on board shipping point, free on board destination. Question. Notice, guys, I'm not showing you journal information on this. This is what very much legal terms, but accountants need to be aware of these things because you need to know that if the goods are in Kansas City and they were shipped free on board shipping point, you still count them as though you received them, even though you haven't physically received them yet. And if it was free on board destination, if you are the seller, you pretend like you still have those goods in your inventory, but they're on a truck in the city, and it's the buyer who would not inventory. Question.
When it comes to accounting, we're going to count this like as a shipping point for the buyer. then the business then will be paying for, will be paid from the, where categories and as well.
I follow the question.
If it's the buyer, if we're having the buyers, then it's gonna be, we're to put it on the accounting as, not retained earnings, but as, not really that used, like supplies that are not used.
If it's free on board shipping point, the buyer takes title as soon as the goods go onto the truck, so they would debit, nothing to do with it. They would debit inventory and credit accounts payable or whatever, even though they haven't received the goods yet, because they have legal title. If it was free on board destination, they would wait until they got the goods. Okay, so let's say I'm a buyer of inventory. And I have two sets of inventory that was sent to me. One was free on board shipping point. One was free on board destination. Say this one was $100, this one was $100. I bought it for $100. Okay. This stuff gets shipped on, I don't know, December 15th, and it's still en route at December 31st. Okay. Let's make it $200. Okay, what would happen? I'm the buyer. What journal entry should I make for shipment number 1? The goods are just being shipped 12/15, and by December 31st, they're still not here. Still en route by December 31st. For the free on board shipping point, what journal entry should I?
Maybe a credit to inventory.
Did I say I'm the seller or did I say I'm the buyer? Would there be any reason for me to credit my inventory if I'm the buyer? So what would I do?
That
You want me to debit the inventory for $100, and you want me to credit accounts payable for $100? But I don't have the goods yet. So what? If it's free on board shipping point, as soon as it gets on the truck, I don't care if that truck, as soon as it gets on the boat, I don't care if it's overseas, wherever. As soon as it gets on the truck in New York, I own the stuff because it's free on board shipping point, meaning I took title to these as soon as they got on the truck. Just the terms of the deal. Okay, how about the free on board destination? I haven't received it yet. What journal entry should I make there? What journal entry should I make there? Nothing. They still are the property of the seller. I have not taken title to that inventory, and the buyer will continue to sell it. In that case, will continue to carry that in their inventory. Even though it's not on their premises, it's counted as though they still have it, right? Question?
yes, for the point, we also have to send it to that part of the phone.
Related to transportation.
But you get the buyer, but
If the buyer paid transportation costs at that point in time, yes, they would debit. I don't know why I'm saying credit. Transportation costs, they would debit, they would show credit back or whatever they paid for that or payable, capital deliveries, instead of payable. Yes. Question. This is the preview it's gonna get today, by the way, so if you're getting hot around the collar, this would be a good time to, pull yourself off and ask a question, clear your mind, because this is as easy as it gets. Free on board today, free on board shipping point, counted, it's always in your ending inventory, even though you haven't received it yet. Free on board destination, don't count it until you receive it. That's it, I don't know what else to tell you. Okay, okay, good. Now, when we look at inventory items, we use, consigned goods. Let's say that, I write a book, and the book is called The Beauty of Accounting. And so I go to Barnes and Noble and I say, please buy this book from me and sell it to your customer. And Barnes and Noble looks at the title of that book. And think, I don't think so. They take pity on it. And they say, well, look, you can leave the books here. If somebody buys them, we'll give you the money for the sale and we'll keep, say, 1% sales. How about that? And I agree to that. End of the year comes, those books are sitting in what, Barnes and Noble store? I will still count them as what? My inventory, because Barnes and Noble will say, hey, we'll buy the book from you, they're simply what? Letting me keep the books on their premises just in case somebody comes to buy them. So at the end of the year, I would count those items in my ending inventory, even though they're sitting in Barnes and Noble store. Barnes and Noble would not include them in their inventory because they never bought it from me. They just what? We worked out a deal where I put it at their store and people saw it and wanted in their store, so we could have, interested enough in accounting to buy that book. Then I have a sale, don't I? And I have some sort of expense or whatever. Maybe I pay Barnes and Noble, the book selling for $100. I give them what, $10 off their sale, right? Yeah, for the 1% they get, so if you were to compare, Barnes and Noble account, the whole thing, to my account, when I leave the books there, nothing happens, show my inventory, right? Then when I sell the book, and let's say the cost of the book was, let's say $40, okay? I'm gonna debit, this is John. I'm gonna debit cost of goods sold for, what did I say, $40? Credit inventory. Now, I'm assuming the books were already in my inventory, because even though I left them in Noble, so I left them in my inventory. So let's say they sold a book, okay? And then I'm going to credit, say cash, say Barnes and Noble sent me cash, I'm gonna debit cash, $100, send it to cash. I'll credit sales, $100. And then I'll debit something probably called commission expense for $10 and credit cash for $10 and then back, I'm sending back to Barnes and Noble. Maybe Barnes and Noble only sends me $90, so I would debit cash, I would debit expense for 10, credit sales for 100. Okay, in Barnes and Noble, they would do nothing for, they might have some system, but because they don't want me to come back. So you stole my books, they probably have some record keeping, but as far as their accounting records go, they're not gonna record anything for inventory for those books that are sitting right there on their premises. But when they work the sale for me, then what? Then they can go ahead and debit cash for $10, that's the $10 that I sent them, and credit, I don't know, commission revenue or something for $10, because they take that revenue for that chunk that they got. Okay, the moral of which is a little beyond where we need to go right now, the takeaway from this discussion is what? The goods that are in Barnes and Noble's possession, I would count those in my inventory, even though they've got it. They would not count those because they didn't buy from me, they're just letting them sit there as an accommodation. Okay? Okay, good. Now, let's take a look at cost of assumptions, okay? Specific identification isn't really labeled here cost of assumption because it's not a cost of assumption. If I sell a Porsche, I'm a Porsche dealer, I sell a Porsche, what am I gonna do? I will debit cost of goods sold for the cost of that Porsche, I'll credit the inventory. Car dealer will for the cost of that Porsche, then we'll debit cash and credit the sale for the sale of that, right? That's specific identification, and you use those for large ticket items. Because you're tracking those specific inventory items. Some companies will choose a cost flow assumption. And there are three different cost flow assumptions that we're going to learn in this class. One is first in, first out. The other is last in, first out, and then we'll talk about weighted average. Okay, these are methods that companies are allowed to use. And notice it says the word assumption. That means that the goods may not actually flow this way, if they are allowed under accounting standards to pretend that this is the flow of their goods. We'll learn about all of this here. Okay, now, specific identification is easy. Okay, what happens? When you sell something and the thing costs you $700, you debit cost of goods sold, you credit the inventory for $700. You sell something that costs you $800, you debit the cost of goods sold, you credit the inventory for $800. Very simple. You're tracking the cost of those individual items. Anything that hasn't been sold yet, you look at it and you see it's still here, it's in ending inventory, from ending inventory 750. Really what we were doing in chapter 5. Right? Now, cost flow assumptions, and they put up here that most companies use FIFO, some companies use LIFO, some companies use average, and then there's some boutique kind of inventory methods that we don't get spots like some companies they use. Okay, notice guys, it does not need to be consistent with physical movement of goods. Okay, so let's talk about first in, first out first. Okay, and you guys ever go to Safeway? Anybody ever heard of Safeway? Okay, and so you go to Safeway and you want to buy some milk. Safeway, okay? So this is you, and you have a shopping cart at Safeway, and you push your shopping cart back to the back of Safeway, and they have the milk fridge back there. You can buy some milk, okay? And they're selling those milks for $5. And they have some milks sitting in there, and they bought those milks. Don't worry about stuff rotting, okay? They bought those milks on November 1st, and Safeway's cost was $4.25. That's Safeway's cost, $4.25. Safeway bought the milk from the cow for $4.25 per gallon, and now they're selling it to you for $5, right? Safeway gonna sell the milk for more than what they charge you, but
Yes.
they're gonna charge you more than what they paid for it. Safeway, right? Okay, then what? They have some milks that they paid $4.50 for, and they bought those for $4.50, and then they have some milks, okay, that they bought on 11/30, and they paid $4.75 for those. Is their cost. Does Safeway have rising prices here? Is Safeway's price of the milk going up? It's not. Safeway not price, the cost.
Yes,
The cost of their milk is going up, they're keeping it $5. Cost is fair, correct. Okay, so what happens? You come in and you buy the milk. And under the first in, first out, FIFO, first in, first out cost flow assumption, we assume that you put the $4.25 one in your cart. You put that $4.25 one in your cart. Now you sit there and say, well, Of course, it's 425. You may say, no, I never take the first one, I reach to the back and I grab that back one because that one's gonna be fresher, because it just got delivered. It doesn't matter. For the first in, first out assumption, we assume you take the 425 one, I don't care if you go in the back. And beat up somebody and take those ones that are the newer ones, the assumption for Safeway is that you took what? The 425 one? It's a cost flow assumption, okay? And I should probably have got to draw, I want to draw on the board on the wall here, but here's the Safeway truck that's delivering those. Okay, so what happens? You're sitting there and I don't care if you went in there and beat up the truck driver and took these. It doesn't matter, we're gonna assume you took those. Okay, so when you take these items and you buy them, what journal entry would Safeway? Right, we just sold you those things for $5, what journal entry? Okay, good, credit inventory for 425. Good, what do you want them to debit here? Good, you want them to debit the cost of goods sold for 425. I don't care if they grabbed that, I don't care if they snuck back there and beat up the truck driver and took the 475 one. We're going to assume that they took the 425 one. It's not specific identification, all right? Anything else in this journal here? Anything else Safeway should do? Anything else Safeway should do? You don't want them to book the sale?
That's
You
what,
want them to ignore the sale here?
that's those ones,
Huh?
yeah,
So what do you want them to do for the sale?
75 cents,
Huh?
75 cents.
No. What do you want them to do for the sale? Huh? You want them to credit sales for $5 and debit what? Cash?
425.
Debit has to be for credit.
I was trying to
I'm
like.
gonna debit the cash for $5. And they got cash, they have a sale of $5, they sold inventory that cost them $425. Okay. All right, good. What's Safeway's gross profit in it? Huh? 75 cents on their income statement, they're gonna show sales of $5. They're gonna show cost of goods sold of what? 425, and they have therefore a gross profit, gross margin of 75 cents. Good, I see somebody looked at those questions. Check. Okay. What's Safeway's ending inventory? What's their ending inventory? They bought 3 items. One they paid $425, one they paid $450, one they paid $475. When they bought those, let me back up, when they bought those from the cow, what journal entry did they make when they bought these 3? Did they? This is their inventory account. When they bought the 425 one, what should they have done to their inventory account? They would have debited the inventory account for 425. Credit cash, credit accounts payable, whatever, right? Okay, good. When they bought the 450 one, what did they debit the inventory? What did they do to the inventory?
When they bought it.
Yeah,
Oh,
they would have debited, huh?
they did it.
When they bought this one, what did they do to inventory? When Safeway bought this, what did they do to inventory? when you buy an inventory item, what journal should you make?
Debit.
Yeah.
Oh.
Yeah, I didn't hear you, that was,
Sorry, that's
okay. 450? Okay, good. When they bought this one, what did they do to inventory? Debited it for 475. I'm not writing that journal entry, credited cash or accounts payable, whatever. When you buy inventory, you debit in, is inventory an asset?
Yes, and during that, excuse me.
Is inventory an asset? How do you increase an asset? How do you increase an asset? You debit it, so when they bought the inventory, they debited the inventory, right? Okay, good. When they sold the item, they debited cost of goods sold and they credited inventory, didn't they? So if I credited inventory, simply posting that credit inventory. Now can you answer my question? What is Safeway's ending inventory?
$9.25.
$9.25, the things that are left in there, the sum of the 450 and the 475. Those things are left. But what if he went and beat up the truck driver and took the 475 one? Doesn't matter. We assume that that 475 one cost Safeway what? 425. Go ahead and be just passionate about this. So when you get into some position and you're tasked with selling something and you have no idea as to what they're talking about in the inventory, that's when people start asking questions like this. Well, boss, how come I don't get included in the meetings anymore? And boss, if I say this directly to you, but if it says you're an asshole, you say stupid things, we don't want to hear it anymore. Okay, so what happens? You sit here and you have what? 450 plus 475, those things are still in inventory. The first things they bought are the cost of goods sold, right? Okay. Okay, good. Now. Let's talk about last in, first out. Okay, and when we talk about last in, first out. We say the last things that the company bought are the first things they will sell. Now, I had a landscaping project I was doing in my house years back. And I wanted to put some decorative rock in the backyard. And the guy said, you have to come to the rock place to pick the rocks for us. Why do I have to come? It's some pretty rocks. No, you gotta come. And then I realized they're saying that because they want me to point to the pile of rocks. So that later on, I can say, those aren't the rocks I want. Can you imagine? You got to put all those rocks in, and then the person says, we don't want them, then you gotta take them all out. So they know you come, you point to the ones you want. Okay, fine. So we get to the rock place, and there's all these different piles of rocks sitting around. And being the accounting nerd, I go, a place that actually the inventory is sold last in, first out. Okay, because what happens? The first rocks that the rock company bought are at the bottom of the pile, aren't they? Okay, then what? Then they bought some more rocks, say for 450, those got piled on. And then they have the most recent ones that they bought, and the rock, person that sells them the rocks, dump that on top of the pile, didn't they? Okay, then what happens? Here comes my guys to buy the rocks that I want to put in my backyard. They're selling for $5. Okay, and what happens? My guys come and they don't say, hey, knock down the pile because we need to buy those ones that you bought a long time ago. They bought these on 11/1, these on 11/15, these on 11/30. They simply do what? They simply sit here and take off the top of the pile, don't they?
Yeah.
So what is the cost of goods sold for this company? For the rock company?
The 475.
475, we assume the rocks that they took cost them $475, what's their ending inventory? Assuming they haven't completely sold all of those. I mean, assuming they sold all of those, what's their, huh?
875.
Assuming they sold all of these, what's their ending inventory now? What'd you say? 875? Oh, I'm sorry, yes, that's correct, sorry, yeah. Assuming they sold all of those, it's 875, assuming those are still there and they sold all these 475 ones. What's the rock company's gross profit? What's the rock company's gross profit?
For the cents.
25 cents.
25 cents, good, very good. $5 minus the what? The 475, they have a 25-cent gross profit. Now, for the rock company, it's probably true that the goods really do flow that way, right? You're not gonna I'll get down to the bottom ones. They're gonna charge you $5 regardless. Okay. Could Safeway use LIFO if they wanted to? Yes. Companies are allowed to choose the cost flow assumption. So if they wanted to, the rock company could have used FIFO and Safeway could have used LIFO. It doesn't have to comport to the actual flow of goods. A company can choose the inventory method that they want to use. Now, if you were a company, which would you choose? Would you choose LIFO or would you choose FIFO?
Depending on the product, like that right there is rocks, so I'm not gonna pick the rocks at the bottom.
It has nothing to do with the actual flow of goods. I don't care how the goods flow. You get to choose. You could be Safeway. And I'm telling you, you can choose LIFO if you want to. Even though the person bought the 425 one, you can assume that they bought the 475. You can choose. You can decide, do you want your gross profit to be 75 cents? Or do you want your gross profit to be 25 cents? You can choose.
75.
You say you want to choose,
75.
so you want to choose FIFO then? You're saying FIFO is a better way to go? Okay, anybody else got another idea? And I'm not saying you're wrong, because companies choose. Companies like, you saw that pie, this pie shape where people choose different ones, if companies choose different things. Anybody want LIFO? Do you guys like paying tax? Because that's going to yield a higher net income. Higher net income means higher tax, doesn't it? So a lot of companies choose LIFO because they want to be able to pay lower tax. You can have a lower net income if you have a period rising price, can't you? Okay, I'll talk about average costs. As an example, okay? So let's look at some of the effects on the financial statements of using FIFO versus LIFO, okay? Major advantage of FIFO is that what? Ending inventory is pretty much reflecting what the current market is for these things, isn't it? I mean, they still are showing the 475 ones in ending inventory, and that's pretty much what they are now currently paying for, right? So ending inventory looks good. And disadvantage of LIFO is what? The income statement is overstating income to a certain extent, because even though they said they sold that 425 one, to replace these items, they're gonna have to pay a lot more these days, aren't they? So they're showing a nicer net income, which isn't really considering this rising price situation. Okay. With LIFO, what happens? The income statement is more accurately reflecting what's going on with prices right now, isn't it? They're showing sales minus pretty much what they're paying right now for their product. But the ending inventory is what? Ending inventory is not reflecting current prices. So the ending inventory is sort of understated. Here's a big problem with LIFO. And this is the reason that the International Financial Reporting Standards do not allow companies to use LIFO. US did want to get rid of LIFO because if you get rid of LIFO for financial reporting purposes, you can't use it for tax purposes. And companies want to use it for tax purposes, they don't like to pay tax. And so they went and lobbied Congress and said, no, don't go over to IFRS, don't do it. Because they were trying to preserve LIFO as a legitimate inventory taking method. Okay, so what happens? Let's say I'm some slick, consultant. And I come in and I say, I'll tell you what, Rock Company, I got a way of increasing your income. I'm gonna increase your gross profit overnight. And I say, one way we can do this, because I think we're carrying too much inventory. Stop ordering any more rocks. Don't order any more rocks. So we stop deliveries, receiving deliveries of rocks. And pretty soon we sell all of the 475 ones. We sell all of the 450 ones, and we're only left with these 425 ones in inventory. And then we finally go ahead and we sell some of these 425 ones. Then what's going to be my cost of goods sold? Then my cost of goods sold becomes what? 425 as I sell those 425 ones. And now all of a sudden the gross profit is what? 75 cents. And then I say, well, I've achieved my objective. Please give me the bonus for our contract forever because we're showing you better net income. See what a genius I am? And I head off into the sunset and I leave the company with what? A huge profit. They've got what? A limited amount of inventory left and they're going to have to replenish that at higher costs, aren't they? So there's going to be a reckoning. It's gonna come a little bit later after I'm already gone. So companies can do what? They can manipulate their income more easily using what? Using the LIFO method, and for that reason, IFRS said no. United States did not do that because companies want to continue to use the LIFO method for tax purposes because they pay less tax. And thus having LIFO conforming. Okay, now I'm going to show you weighted average. Okay, as part of, and I'll teach you weighted average as part of the in-class example. So take one and pass it back. The same thing that I'm handing to you is also on tape. Yes, thank you. If you have extras, please bring them up. Great, thank you. Or, yeah, you can bring them. That's great. Thank you. Okay, thank you, sir. And I want to open the file up here. I'll just go ahead and bite the bullet and open it here. I guess it's good so you can see where it is anyway. So the thing I just handed you is right here, chapter 6 in-class example. Okay, and I'm just going to go ahead and download it. Oh, there it was. I was right next to it. Don't worry if it says chapter 7. It's chapter 6. Is this what you have in front of you? Okay. And I need you, it's two-sided, but I need you to look at the side that says during its first year of operations. Little Busters, thank you. During its first year of operations, you see that? Okay. Okay, so during its first year of operations, this Little Busters Corporations has purchased its entire inventory in 3 separate batches as follows. So batch one, I'm going to assume they bought that. I'm gonna assume that they bought that on 11/1. Batch 2, they bought on 11/15. And batch 3, they're going to buy on 11/30. So they bought a total of what? 9,000 units, 9,000 items. These are items, these are not dollars, guys. These are not dollars. These are the number of items. They what? They paid $425 for the first batch, $450 each for the second batch, and $475 each for the third batch. So to figure out what the cost of the first batch is, you take 4,000 times 425. It's per unit. Is that cost? Okay. Now, if you wanted to get a sense as to what was going on with their inventory, the beginning inventory, since they just started operations, was 0. They purchased what? 9,000. I'm telling you that there were 9,000 units available for sale, and I'm telling you that they sold 4,000 items. So that means in ending inventory, they have how many items left? 5,000 items left in ending inventory, right? With me so far. Okay, so now I want to go ahead and I'm going to show you FIFO first. Okay, and I want to figure out the cost of goods sold and the ending inventory. That's what I'm trying to do here. And I'm going to do FIFO first. What are the amounts of ending inventory and cost of goods sold? To figure out cost of goods sold, I assume they sold what? The 4,000 that they bought on 11/1. I assume they sold those first and they paid $425 for those. So to figure out the cost of goods sold, I take what? 4,000, all from the first batch, times 425. So their cost of goods sold would be $17,000. They would debit cost of goods sold, 17,000, credit inventory for 17,000 for those items. Okay. For the ending inventory, there's what? 5,000 items were left, right? They bought 9, they sold 4, so 5,000 are left. Those are what? 2,000 are from batch 2, 3,000 are from batch 3, aren't they? So to figure out that cost, I take 2,000 times the 450, and then I take what? Right there. And then I take what? 3,000 times the 475, that gives me 14,250. I add those two together, so the ending inventory is what? 23,250. Question? If you're waiting for deeper meaning, stop. This is all. That's all there is to it. You simply do what? See how many items they sold, take them from what? The appropriate batch, since we're FIFOs from the first ones they bought, apply the cost of that. That's your cost of goods sold. Whatever's left in ending inventory is ending inventory. Okay, let's do LIFO. Let's do a LIFO, and we're going to use the same information. We're going to do the same information, and now we're going to do LIFO. Okay, so what happens with LIFO? It's last in, first out, isn't it? So and let's just look at the cost of goods sold here. We assume that they sold the 475. Remember, they sold 4,000. We assume they sold the 475 ones first. So 3,000 times 475, but they sold a total of 4. So we still need what? 1,000, don't we?
So we take 1,000 from that second batch, 1,000 at what? At 450, okay? And when we use 1,000 at 450, right here, that gives me 4,500. I add those together, the cost of goods sold is 18,750. I couldn't take them all from the 1130 batch because I didn't have enough. So I had to go to that next batch, didn't I? The ending inventory, therefore, is going to be what? Well, there's still what? We sold 1,000, so there's still 1,000 of these here. Remember, there's a total of 5,000 items in ending inventory. So 1,000 of those we will cost at what? At 450. The remaining 4,000 we will cost at that 425 because those are still presumed to be sitting in ending inventory, aren't they? How many items do we have in ending inventory? How many items do we have in ending inventory? 5,000. Well, I better find 5,000 units. I can't count these because they're all gone. I can't count all of the 2,000 because I assume they sold 1,000 of those in the sale. So I'm left with what? 5,000 items that constitute of the 1,000 items that are left in batch 2 and the total 4,000 that I bought in batch 1, right? Notice I use the same information, Buster's Company, and I show you how they can calculate your inventory under 5 line and symbol, which is it? They can choose whatever one they want, okay? Question. Now, weighted average is the easiest one. So I figured I'd say that for last. Weighted average is easy. With weighted average, what you do is you sit here. I'm sorry, I was showing you that up there. I meant to go up to the table. I was showing you there in weighted average. I should have gone up to the table to show you what I was talking about. There's what got sold. But anyway, for weighted average, it's very simple. What you do is you add up the cost of everything that was ever entered into your inventory. You add that up, 0 was the beginning, 4,000, 2,000, 3,000, 9,000 items are in inventory. You extend the cost, 4,000 times 425, 17,000, 450 times 2,000, 9,000, 475 times 3,000, 14,000, 250. You add that up, and then you divide that total cost by the number of units, and you come up with a cost per unit. Now, they call it weighted average because what? Each item was weighted by the number of items that it had in there. That's why they call it weighted average. You add that up, you divide, and the weighted average cost per unit is 4.47. And I'm doing that because if you just put 4.47, you're gonna get different numbers if it's on there, because I didn't round it out. You'll have to do anything after that. Okay, so ignoring rounding here, it's 4.47. You take what? The 5,000 units that are in ending inventory. We have 5,000 units in ending inventory, don't we? We multiply that by what? 4.47. And when you do that, you get 22,361. That's my ending inventory. For the cost of goods sold, how many items did we sell? 4,000. We take the 4,000 times the 4.47.
17.
889. Weighted average is the easiest one, isn't it? The only thing that makes FIFO and LIFO a little bit weird is you gotta kind of cram your brain into how the goods are being used for versus the gold. Okay, so that's year 1. A little bit over. We're gonna go through another year with this company. Okay, so when you come to year 2 now, okay,
Now we get some additional facts here. They have the 5,000 items that were in last year's ending inventory become the 5,000 items that are in this year's beginning inventory. You bought 7,000 more items. Buster's bought 7,000. So they have goods available of 12. I'm assuming they sold 9,000. So that means there's 3,000 items in the inventory. Starting here with 5, bought 7, they had available 12, they sold 9, so they got 3,000 left. Right? Okay, let's do weighted average first this time, since that's the easier one. And what I do is I go ahead and I weight each item by the associated cost. Now notice, guys, my beginning inventory, I've already weighted it at 4.47, and but I go ahead and I bring that in, that cost I had calculated at the end of last year. Last year's ending inventory, this year's beginning inventory. And then I bring in, and by the way, I assume that Buster's is paying $5 per unit for those 9,000 they bought in year 2. They paid $4.75. That's prices going up for Buster's, okay? Okay, so they had to pay $5 in year 2 for the what? And that's batch 4 for the 7,000 they bought in year 2. Batch 4, that's 35,000. I add the beginning inventory plus what they've added this year. There were 12,000 units available. Divide that by the total cost of 57,000. I come up with a weighted average cost per unit of 478. And for the beginning inventory, the ending inventory, there's 3,000 units that are gonna be left in ending inventory. I use the 478. For the items they sold, 9,000, I use that 478. How many units were in beginning inventory? How many units were in beginning inventory? Oh, no, in this example, 5,000. How many did they buy? In this example, 7,000. How many units did they have available? 12,000. How many did they sell? Huh? No. They sold what? Oh, you say 9, I thought it was 5. They sold 9,000. They sold 9,000. How many items are left in ending inventory? 3,000? Right?
Yeah.
Right?
It's,
Okay, good. So what I did is I took the cost of the beginning inventory. I added the cost of the stuff they bought this year. They bought 7,000 at $5 a pop. That was 35,000. Came over the total, divided it by the total units that were available. That's called a weighted average cost. Once I got that weighted average cost, then I'm home free for the items that they sold. They sold 9,000. I multiplied by that 478, whatever per unit. And for the ending inventory, the 3,000 that were left, I multiplied that by the 478. That's the easier method, isn't it? Weighted average. Now, let's do, you want to do FIFO or LIFO first? Okay, so we'll do FIFO. I'm saying that because I think it's easier. You like LIFO better? You think LIFO is easier?
we just did FIFO.
That was weighted average. I'm doing FIFO then. Okay, FIFO. So what happens? How many did they sell? How many did they sell? 9,000. So I got to find 9,000 units, don't I?
Yeah.
So what happens? First, I go to what? I go to the 2,000 units, all from the beginning cost of goods sold. What am I doing here, John? What year am I in? Oh, okay. That's what it is. Remember, under FIFO, we assume that all of these batch one ones were gone, right? We assume that we sold them all. So they're gone. There's no more batch one ones because we sold them in the first year, right? Okay, so now to constitute the units we're gonna sell, we're gonna get what? 2,000 from here at 450, 3,000 from here at what? 475. That's gonna give me 5,000. I still need what? 4,000 more units, and I'm gonna take them from what? From the 7,000 that I bought in year 2. Right? The $5 ones. Let me say that again. How many units do I need? I have 9,000 units that I need. Okay. I can't take any from batch 1, they're not. I have 2,000 in batch 2. That's 2,000 from batch 2.
So 2,000 batch 2 times.
Times 450. 2,000 from batch 2. Batch 2 had 2,000 and those cost me what, 450? I had how many in batch 3 from last year? 3,000 that are left. Those cost me what? 475. In year 2, batch 4, I bought what? 7,000, didn't I? I bought 7,000, so I need how many more units to make up this? I said I sold how many? I said I sold 9,000, so from batch 4, I need to take 4,000 from there, don't I? For batch 3, for batch 4. So what happens? I go ahead and I take those. How many did you send me? 4,000. I take those 4,000. That now gives me the total, and those were at what? At $5. Thank you. Here you go. Those were at $5. Okay, and when I do the extensions on those, and you can see those on your paper, when I do the extensions on those for FIFO, that's what I did. 2,000 at 450. I did 3,000 at 475, and I did what? 4,000 at $5. I add those up. That's my cost of goods sold. Since I now have taken 4,000 of these, there's only 3,000 of them left, right? That's my ending inventory. That's the item that are ending inventory. 3,000 times the $5 each means my ending inventory, you can see it here, is 15,000. First in, first out. You ask a series of questions. Batch 1, batch 2, batch 3, batch 4. Did I have any left from batch 1? I gotta come up with what? I gotta come up with 7,000 units to sell, all right? 7,000 or 9,000 units to sell. I gotta come up with 9,000 units to sell. Is there anything left from batch 1? I sold it all last year under the FIFO assumption, didn't I? So that's gone. So now, okay, well, I bought those batch 2 ones on 15. Those are still here, aren't they? 2,000. Then what? From batch 3, 3,000. I got 5. I need what? 4,000 more. I only have the amounts left from batch 4, right? 4,000 from batch 4. And that can leave me with 3,000 that are left in inventory. Cost it at what? $5, right? Okay. Okay, good. Let's do LIFO. Huh? Are you kidding me? There's no LIFO on this page? Okay, here it is. Let's do LIFO. LIFO, L-I-F-O stands for last in, first out, last in, first out. That means the last goods I bought are the first goods I sell. So I need how many goods? 9,000 is my sale. So I assume that all of those 7,000 that they paid for 50, they sold all of those, didn't they? So I need what? 2,000 more?
And I've got what? I've got 2,000 that are left from batch 3, don't I, for the previous year? So I go ahead and I grab those 2,000 from batch 3 the previous year, those were costed at $450, and that gives, oh. I'm sorry, my bad. Damn it. Under the LIFO assumption, we assume that they did what? That they sold all 3,000 at batch 3. So there's no more of those left. And under the LIFO assumption, we had assumed that they sold 1,000 of the batch 2. So there's only 1,000 of those left, right? So I'll grab what? I'll grab 1,000 times the 450 ones. And then I grab 1,000 times the 425 ones. And so I get my total cost of goods sold by adding those up. And the 3,000 items that are left, I assume they're all left from what? Batch 1, because the assumption was I never sold any of those. If those are costed at 425. Okay, let me do that again. I sold how many units? 9,000. I sold 9,000 units. On the board. I sold 9,000 units. I need to find a way to make up 9,000. I had 7,000 from batch 4. I assume they sold those first, didn't I? Times $5. Then what? Okay, now I'm going to go to the next available batch 3 from the previous year. But I can't get any of those because I assumed I sold all those under LIFO last year. So I sold 4,000, I assumed all those 3,000 were gone from last year, right? So I can't count any of those. They're all gone. I assume I sold them last year. I can't sell them twice. I assume I sold all 3,000 of those, remember? Okay, so now I have to go to batch 2, for which there's items that are left. But in batch 2, I assumed last year I sold 1,000 of those, remember? So there's only what? There's only 1,000 of those left, which I'm costing at 450. And then I still need what? I still need another 1,000 units. Those are coming from what? From batch 1, because under LIFO, look back at the first year. We didn't assume we sold any of those. We assumed all 4,000 of those were still there, okay? We got 1,000 of those we can pick up now. That's at what, 425. And that's how we came up with this total number here, 35,000, 4,500, 4,250. That's how we came up with the cost of goods sold. Ending inventory is what? The 3,000 units that are still here in batch 1. Okay, 425. So you could think of LIFO as fish. First in, still here. You want to eat that fish? If that fish has been around for a year, you probably don't want to eat it. Okay, first in, still here. So what happens? Think of it that way. I mean, you're depleting the goods in order of how you bought them, right? Backwards. Okay, so most likely, most LIFO questions, the first stuff you bought is still going to be there, isn't it? First in, still here, fish. And you can sell that stuff. Question.
I have a question. So 3 different methods, they all have different ending inventory. We can go over.
You have different ending inventory, different cost of goods sold.
Yeah. We go over like quickly why someone would want, I guess, a lower inventory than it should LI as well. But
They are gonna choose it because, it's, we're assuming price. Historically, a pretty good assumption, prices can go up. So in a period of rising prices, LIFO will result in noticing a lower inventory balances, but and lower net income. But there's a rule in the Internal Revenue Code that if you want to use LIFO for inventory purposes, you also have to use it for financial reporting purposes. So companies want to use it for tax purposes, which is going to give them lower net income, lower taxes. Companies like to pay taxes. No, so they choose LIFO to account for their inventory under tax purposes, and then IRS says if you use it for tax purposes, you must also use it for financial reporting purposes. So they're stuck with it. They have to use it for financial reporting purposes if they want to use it for tax purposes. So they're happy to show a lower inventory, a lower net income. Really want to show the work. I mean, IRS is saying that because think about it. That would be kind of a bad precedent to set in the markets. If you let companies use LIFO for tax purposes to get lower net income, lower tax, and then you let them go ahead and show higher net income for investment purposes. So we're starting to kind of, make a mockery of things a little bit. So they say, okay, to make this thing a little more palatable, we're going to go ahead and we're going to, make you report using LIFO for financial purposes. Good. Now, the question, begging question, burning question, well, then why would anybody pick LIFO? LIFO has a more difficult record keeping prospect. And then what? If you're Safeway, and your goods actually flow FIFO, which most companies do, then what? It's easy to keep track of your inventory as you sell it. Debit cost of goods sold, credit inventory for whatever it is you sold, right? That's how it's actually flowing. That's not that difficult, right? Okay. If you're Safeway, you say, no, I want to use LIFO. Now you've created for yourself a pretend record keeping system that pretends that the stuff that you just sold is not what you just sold. The stuff that you just sold is actually still in inventory, and you sold the stuff that's still in inventory. That becomes a little more difficult to keep track of that, right? And so what companies do is they do a cost benefit analysis. Is it worth it for us to take on this extra burden to use FIFO for the tax savings? And if they determine the tax savings isn't saving us enough cost of the extra record keeping to use LIFO when our goods actually flow FIFO, just use FIFO, get this shit done on base, just FIFO. So that's why I had that plot out. Some use FIFO, some use LIFO, right? So you have to ask yourself, well, what companies do you think would have a large tax bill? You think of really, 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 really profitable companies that might want to lower the tax. Sells inventory. You must all own electric cars. You all own electric cars, and you're not sitting there at the gas pump. So what happens? The oil companies are the big ones that use LIFO. Do oil companies have any lobbying power, do you think? That more than anything killed the US going over to IFRS, because IFRS says no LIFO. We're not gonna let you manipulate things that way. No, we're not gonna let you do the pile thing where you erase the files and all this. We're not gonna let you do that. We're not gonna let you control your net income now. That's a really bad thing. We're not gonna let you do that. US is supposed to adopt IFRS. They see this rule that IFRS says no LIFO. If you don't use LIFO for financial reporting purposes, you can't use it for tax purposes. They saw the big tax bill coming and they took their lobbying power. You do it, the terrorists have won. They say whatever they have to say. Leave it not. So that's the big reason the US didn't go right for us. Okay, so here's what we got. On campus, there is a practice midterm for chapter 6 that leverages right off of this example. Okay, I want you to go through that very carefully over the weekend. Understand it very carefully over the weekend. Then there are some additional questions there that, we'll go through that. I'm gonna ask you to look at them.
Where's my canvas? Did I lose it? Hang on, guys. Hang on, guys. Okay, if you look at chapter 6, if you have to go because you have to pick somebody up, that's fine. You already talked to me about that.
So chapter 6.
Just a second. So let me get it up on the screen. Okay, chapter 6. Let me put it in student view. Just a second. This Barbie paint for student view. Okay, so chapter 6.
Okay, we just went through the in-class example, chapter 6 in-class example, but you see the chapter 6 practice midterm with and without answers.
Yeah.
With and without answers. You do the one without answers. If you can work it, and if you get stuck, you can check yourself with the with answers. We'll go through that together on Monday. And then there's some additional chapter 6 questions that I want to go through with you. And then, whatever time we have left, we will go through some more practice feature questions that'll be similar to what was in chapter 5. And then, what did I tell you? I'm gonna open the midterm after class on Monday.
Yeah.
Is that the deal?
20,
Okay, and it'll stay open until,
26.
that's Sunday, 11 p.m. not on Sunday. Okay. Okay.
I thought you said you were gonna open to the fund, but
No, the 20th.
I said this one is.
Yeah,
Unless you want me to wait.
No,
something like that, that's all. What you said, I don't mind it.
Did I say the 22nd?
Oh, like that's what I say.
I think it's the 20th, 26.
Well, what I said to you might be different than what I said, but, okay, I first, I'm gonna law.
Yeah, it's the 20th, the 20th, do it around time, it's only open for an hour, so. If you want
It'll
to-
be on for 3 hours.
Oh, 3 hours.
Oh,
And if you-
I'll talk more about it.
It's,
Okay, guys, I'll see you.
Hey, we said. Right.
But I'll do something. I'm gonna have them come here to talk.
On the final.
I'm gonna, and I'm gonna do something else for credit for people that didn't. Yeah, I'm going over to ask you the five. And I'm gonna do some. Of what, more questions. Maybe that's five. Oh, are they? Where? Oh, okay, I've been in that though. I didn't buy my car. Bought mine. No, early, record. Okay. Yeah, well, you wanna go to Fremont? Okay, I was thinking of going over there because I got an Audi now and I want to look at it. So now that you know. What's your name? Three? Yeah. Okay, cool. Oh, okay. Well, sounds a good match. That's it. Thank you, guys. cause it's full. I mean, it's still. Assumption. Hundred. Five. I know the meeting for. Five over. Hitting. 4,000. 1,000 feet. The back part of the structure. Units. 9,000. 9,000, 7,000. 1,000. 2, and those are all gone. So on this example, you do the life of after filter, that's what these are usually exclusive. I can start a mission. Okay, right.
Tomorrow, you're open class.
Office hour? Yeah, office hour tomorrow, let me stop the recording. Office hour tomorrow, 10, I think it's 10 to 10:30, whatever it is on,
So there, and then my next thing is, the midterm thing is I gotta.
whatever it says on the syllabus. No, it's still there.
No, the practice midterm is still showing.
Oh, the practice midterm, what do you mean?
The practice midterm, like it says midterm, but then it says the practice midterm, and it makes the grade look bad.
Oh, I see what you mean. No, yeah, that's gonna go away. Yes.